Hello everyone, this is Jimmy Singh, broker owner of Supermax Realty, 647-961-2639. Welcome to my channel Real Estate Edge with Jimmy Singh. In today's video, I like to talk about impact of interest rates in our Canadian real estate market and specifically about Greater Toronto Area, Golden Horseshoe, London, Sarnia, Chatham, and Windsor real estate market. So as we all know, in the media, they are saying that the interest rate hike is coming as inflation in Canada continues to soar. And according to some studies, inflation climbed to a 30-year high in December 2021, according to Stats Canada, sitting around 4.8% compared to the previous year, which is 2020. The steep rise is driving the cost of real estate, food, vehicles, and lot of other necessities of our life. And especially in real estate, I see lot of builders, their prices of raw materials, appliances, they have increased substantially with global supply chain issues. And one of the main intentions of Bank of Canada for the rate hike is to cool our super hot Canadian housing market, and which is obviously fueled by the cheaper mortgage interest rates. And for the last 2 weeks, in January of 2022, I have noticed a lot of my purchasers, since they're expecting the interest rate to go high this year, they just want to rush and make their purchases now. And as I see right now, the first quarter of year looks like to be a repeat of last year. See, the Bank of Canada is expected to increase rate sometime in first quarter of 2022. And at present, the overnight lending rate is sitting around 0.25%, which Bank of Canada has maintained since March of 2020 in response to pandemic COVID-19. And as we all know, this overnight lending rate determines our variable interest mortgages. And they plan, to bring the rate back to 1.75%, returning to pre-COVID-19 levels. And I was reading a report recently by one of the top banks in Canada, TD Bank. They predict that the central bank will hike rates 3 times this year in 2022, followed by 3 further hikes next year, leading to an overnight rate of 1.75% by the end of 2023. So there's a lot of news. Some people are saying we'll see 5 rate hikes of quarter point this year. Some are saying 4 hikes, some are saying 3. My guesstimate is, give or take maybe 3 or 4. So if you're sitting at 0.25, maybe 4 more, those are all, I can see looking at the current environment. And those who have chosen a variable rate may suddenly want to lock into a fixed rate if, they're able to do so with their, banks. And obviously, once it goes back to 1.75, your variable mortgage is going to increase and you should be expected to pay more moving on to the end of this year. And obviously, it will affect your spending power as well. So by contrast, if we talk about fixed mortgages, which obviously are, dictated by the bond yield, which already increased in last few months. As you can see, some investors, they are dumping technology stocks with high valuations and taking the money, put more towards safer, government bonds and stuff like that, right? So what it means, this means that the mortgage or loans for the purchasing houses will eventually become expenses. And the one of the most common question I guess asked in last couple of weeks was, people are showing their concerns about rate increase, and they just want my opinion how this will impact home sales. 10 minutes ago, I just got an email from one of our partner mortgage brokers. He emailed me and he said one of the lenders is increasing the rate Sunday midnight. So probably on Monday, which is 24th of January 2022, the rates for the fixed mortgages are rising, because fixed mortgages are dependent on bond yields, and which have risen in last few weeks. See, if we talk traditionally, folks, increase in interest rate, has historically led to falling home sales and flattening of home sale prices. But we are in a different situation. Currently we have a limited supply of homes which are available for sale, and it certainly will take substantial decline in demand to return, the active listings to a healthy state. Meaning, if I talk about Brampton, Mississauga, Toronto, Kitchener-Waterloo, London, Hamilton, Niagara Falls, Windsor real estate, all these markets which my team at Supermax services, I have seen the listings are really, really very, very tight historically. So, at the end of the day, Bank of Canada will tighten, and it will certainly result in less home sales down the line, because we have already reached the peak, and eventually it will just average out. So whatever the historically average sales are for any city, it will come down from historically highs. So if in Greater Toronto area we sell 100,000 houses every year, it will come down to that, right? So eventually this will happen, but don't read too much into media news, because eventually when the sales decline, they're going to say, oh, market is slowing down. It is not that. It is just the borrowing capacity, and sometimes sales will decline because there's no supply. So if there's less sellers in the marketplace, obviously there'll be less sales, but lot of media just pick, and choose the numbers, whatever, get most eyeballs. So be very, very mindful. And one thing I want to tell you is, an undersupplied market can absorb decline in the demand arising from the higher borrowing cost. Meaning, if the mortgages go high and then the supply is declined, but because of the shortage of the new housing, and there's, that will be really, really absorbed, because in most markets, the listing inventory on the market is less than 0.5 month supply. In most markets, it is less than 1 month supply. So I see all these inventories getting absorbed, irrespective if the interest goes up few basis point during this year. The other thing is, yes, it might, it could moderate increase in house prices, but overall, I see housing market pretty strong in 2022, and I can easily predict that this year I can see the average house prices again growing 9 to 12% in Greater Toronto area, and in mid-tier markets like London, Windsor, Sarnia. I won't be surprised if by the end of year the prices again of the average home goes 10 to 15% up. And another thing is, affordability over the next 2 or 3 years, would worsen. There's a lot of research done on this topic. RBC came up with one of the reports few months back. All the leading economists who study real estate, who see other factors like immigration, baby boomer trends, they see family formations, intra-provincial trends. They're all saying, moving forward, irrespective whatever interest changes government comes up with, we will have affordability eroded for most average Canadians. And what's going to happen is, for investors who are on average mortgages, variable rates, they will see their interest rate going up, reducing their cash flow. So if somebody is on the borderline, they don't have deep pockets or they don't have much savings, they might panic and they might offload some of their properties. But a moderate pullback, in my opinion, may not be a bad thing, right? Given the tighter conditions of GTA. And even in Golden Horseshoe, Niagara Falls, London, or Windsor real estate market. So all in all, if you are looking to buy in any major city, especially Toronto, Vancouver, or most of the South Ontario market, for buyers, I can only say don't sit on the sidelines. So if you have a stable job, 6-7 months of savings, and you're committed to a particular city to live for a long time, you should not wait for the dip or the bubble to burst. You should buy your house, because interest, if you're just sitting renting your property, it's not helping your cause. For example, if your average rent for a townhouse or apartment you're paying right now is $2,500 a month, in 5 years you will be paying $158,181 in rent. I made this calculation based on 4% appreciation on rent, though rents have risen 10 to 12% in lot of different markets. So if you're paying a monthly rent of $3,000, in 5 years, you will be paying your landlord $189,844. So if you're renting a basement, probably in GTA, paying $2,000, in 5 years, you will be out of your pocket $126,518. And that's a lot of money, because incomes probably, yes, wages, are going to increase with inflation, because some business owners are finding it hard to get, new workers, but eventually they're going to tame the inflation, and then the wages won't rise at that pace. So all in all, if you are an investor or a home seller looking to buy sell a property anywhere, give our team Supermax a call. You can call me directly also at 647-961-2639 for a free market evaluation. My website is www.supermaxrealty.ca. And also, if you're a brand new agent or an experienced agent looking to switch your real estate brokerage, give me a call for a confidential meeting. My number again is 647-961-2639 for all these real estate related questions. Anyways, if you're a first time coming to my channel, please subscribe, and if you like the video, you can give it a smash the like button. Or if you have any concerns regarding real estate prices or impact of interest on our housing market, kindly feel free to leave your comments. Thanks for watching, guys. God bless.